Hi folks, it's Dr. Jeff Camarda and welcome to my precise guidance on how to wisely convert your taxable IRAs, 401ks, TSPs, 403bs, what have you, into tax-free Roth accounts. I'm sure you all know the value of that, but the devil is in the details, right? So I've got a couple of programs I'm going to go through. One I call Roth IRAs, which is the fairly detailed process. And I actually, my favorite quote about Roths, it's my quote, is that Rothalization is the art of using tax arbitrage to convert taxable IRAs and 401ks to tax-free retirement income at zero or low tax cost. And I know you find that very exciting. You know, I'm sure, that Roth accounts are tax-free. Traditional retirement accounts, IRAs and so forth, pre-tax accounts, create additional taxable income when you pull the money out, whether you pull it out now or you're forced to pull it out through requirement distributions. Conversions before claiming Social Security can give you more flexibility and save tax on Social Security and some other problems. Besides the tax on withdrawals, the higher total income increases brackets may reduce deductions and negatively impact taxation and benefits under Social Security and Medicare. So this is a really complicated game to get it right. You just want to take a slug of IRA and convert it and wonder what the taxes are. You won't know till April. It could be devastating. It could be a really bad move. Converting to Roth's tax efficiently, however, is like creating wealth for free or supercharging investment returns. Converting avoidable taxes to family wealth is like pulling free money out of the air. And remember, future tax policy is pretty likely, regardless of your political affiliation, under most scenarios, taxes in this country almost certainly need to go up. So what's the Roth IRAs process, which we do through our affiliate TaxMaster, or maybe you can follow at home or guide your tax preparer. But I want to caution you, you need to use a sophisticated tax preparer. These are really complicated calculations and require a deep knowledge of tax law. Conversions before claiming Social Security, again, give you more flexibility. Once Social Security is in the mix, that you really can't change that. Done right, this is really a multi-year strategy. There are many variables that keep changing year after year, including the law. So think of it as a series of games that you want to play and win each one rather than one big game. You probably have more flexibility than you or your tax advisor know, so learn what your options are and use them to your advantage to grow your wealth and avoid taxes. Properly executed, again, it's like pulling money out of thin air. Taxes saved literally is wealth earned. Conversion later in your life when various numbers are more certain is safer. So like it's later in life when you have more clarity on what your tax rate is going to be, Social Security, pension, and so forth, typically is safer. And remember the 5-year rule. It's not tax-free until 5 years after the first Roth contribution or conversion. So these are my best practices. The Roth beneficiary for beneficiaries. Using trusts requires special flexible spending provisions to avoid tax blunders. Spouse of the beneficiary steps into your shoes, unlimited tax-free treatment, but if it goes into a trust without the right provisions, particularly, it will accelerate taxation and could backfire. Now, unlike taxable IRAs, it appears that other beneficiaries can wait 10 years before the first required minimum distribution. So again, this is best executed, and these are the kind of steps that we go through for our tax clients at TaxMaster, and I advise that you go through with an enlightened tax preparer. You really want somebody that cares about saving your taxes and is well educated on tax law, because there's a lot of moving parts. So long-term strategy educated annually when conditions are favorable. In some years, you don't want to do it. You just pass on playing the game. Each year, until all accounts are completely converted. The first thing is decide your acceptable conversion tax bracket. I will pay 25% of taxes and no more, or 21, whatever it is. What you're willing to pay. Remember, IRAs and other tax-deferred accounts, The IRS basically has a lien equal to your tax bracket. If you're in a 40% bracket and there's $1 million in that account, you only own $600,000. The other $400,000 belongs to the IRS. Think of it that way. And you want to minimize the tax bracket to minimize the lien. Estimate your baseline non-adjustable income. This is my salary. This is my Social Security payments. I can't change those, pensions, annuities, and so forth. You really don't have any wiggle room on that. Then look at your variable income to minimize it and look for opportunities to convert Roths when you don't have a lot of income that year. So what estimated deferrable other income? Can you defer a W-2? Can you reduce that? Can you switch to a 1099? Can you take more money next year and not do it this year? Do you have businesses that you can control the profitability somewhat, capital gains? You haven't claimed your Social Security yet, pensions. You have a number of variables. Then estimate potential deductions, business losses, net operating loss carry forwards, Section 179, accelerated depreciation, bonus depreciation, missed, underestimated, or unclaimed business expenses depreciation, like home office, cost segmentation depreciation, that kind of thing. There's a lot of variables there. And so obviously your objective is to minimize your variable income in a year, maximize potential deductions, to drive taxable income down, so when you add conversion of IRAs to Roth to the mix, increasing your income, it happens at a more favorable bracket. Do pro forma taxes to your 1040. Okay, I got load the tax software. Look at the standard deduction, including income for number 2, excluding number 3, and maximize deduction estimates for number 4. I'm referring to these checkboxes here. I should have put numbers here. I apologize, but I'm sure you understand what I'm talking about. Then estimate additional income recognizable to maximize or clear the target bracket from number 1 and convert slightly less of this much to your Roth. So what does that actually mean? Say that, after all these adjustments, I get, my minimum income with deductions and business losses and not claiming Social Security and deferring my W-2 to next year down to $40,000, and I've got $30,000 left in my acceptable bracket. So I can go to 70 and still stay in an acceptable bracket, and of course I'm just making the numbers up. So then in that case, that's the additional income recognizable. So instead of maybe doing 30,000, I made a mistake and I kick over 70 by accident, maybe you do 25. That's really the logic here. For risk-based assets, stocks that go up and down, that kind of thing, convert those that have dropped in value to leveraged tax savings. So if you got an IRA that's gone way down, but you still believe in the stock and you want to hang on to it, that's a good candidate to convert at a lower value. So you pay the tax on a lower conversion value and hopefully it pops back up tax-free. And again, repeat in subsequent years until conversion is complete. I realize that we got really technical really fast there. There's a lot of moving parts to this, and you really want to make sure you get it right to optimize the tax conversion strategy. But done well, this can be magic, especially if you have some variability. And if you'd like to do it with us, and kind of walk you through without charge, a pro forma Roth conversion procedure to give you some insight as to how to do it yourself with your tax preparer, go ahead and respond, and we'll be happy to talk to you and see if we can help you out. Thanks so much for watching. Until next time, this is Dr. Jeff Kumar.